This is the Illinois Farm Economics Summit, the 2021 version. Today's topic, supply bottlenecks and management decisions. Our panelists for the day will include Gary Schnitke and Nick Paulson, both agricultural economists here on the farm at the farmdoc team here on the Urbana-Champaign campus of the University of Illinois. Our topics for the day will include a general economic outlook, the agricultural background that they're using for the day, impacts on farm inputs, including pesticides, machinery, and fertilizer, as we talk about bottlenecks. We would also like to thank our panelists as you fill out our first poll for the day, asking whether you're optimistic about growth in the United States in 2022. We'd like to thank our panelists, not our sponsors, rather, including the TIA Center for Farmland Research, Compeer Financial, Corteva Agrisciences, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers, and the Illinois Soybean Association. Fill that poll out. Are you optimistic about growth in the United States in 2022? There will be a major recession, declining growth, about normal growth, and picking up of growth are your possible poll question answers. And when we get to about 70% of you or thereabouts that have answered that question, we'll go ahead and open that poll up. Again, this is the Illinois Farm Economics Summit. It's the third in the series. If you're here today, you've already signed up for all 5 of them. You can see the first 2 in an archive on our website at farmdocdaily.illinois.edu, and you'll be able to see the next 2, which include farmland values on Monday and policies on Friday of next week on the archive as well, or in person at 11 a.m. on either of those days. So the poll question, we may as well close that out and get some answers there. We see that 41% of you expect declining growth in the United States in 2022, and 37% about normal growth. So we're going to take some of that up as it's related to the growth and the bottlenecks and what things have been happening in the economy and the agricultural economy in particular. With Nick Paulson to begin with. Good morning to you, Nick. Thanks for being with us today.
Yeah, thanks, Todd, for the introduction and handling the first poll question. So now we kind of see where the audience's expectations are for the future. And in this first section of the presentation this morning, we're just going to do kind of a broader general economic backdrop, kind of leading into some of the more specific ag issues that we'll get into later. So the first one is just looking at overall GDP for the U.S. This chart is just showing you the annualized GDP growth rates going back over the last few decades. And obviously the huge drop in GDP that we experienced in the first half of 2020 with the COVID pandemic, the big rebound that we saw in the second half of the year, and then the what would be above recent history averages in the quarters of 2021. So obviously a 31% drop takes some time to recover back to levels where we were pre-pandemic. We have now, looking at projections for 2021 GDP levels for the U.S., we are kind of back to that pre-COVID trend in terms of where we would think we might have been in 2021 even before the pandemic had started, just based on the trend in the 10 years leading up to 2020. So we have seen a rebound and again, a return to kind of the levels of growth in terms of the overall economy that we would have expected prior to the pandemic. Taking a look at kind of measures of supply chains specifically, one of the indicators is just looking at container activity at ports. And so this slide is showing you some of the inboard container activity, specifically at the Port of Long Beach in California. And again, you could kind of eyeball what a trend line would have been from 2010 to 2020. We see the decline, pretty pronounced decline in 2020 due to the pandemic, but then the jump up, again, associated with the economic rebound to levels that would be even higher than where we might have expected prior to COVID. So a lot of activity going on at the ports, and probably more activity than they necessarily would have been prepared for. Again, that trend line leading into 2020. And so definitely some bottleneck issues going on, growth and pretty big changes in supply chains. Another general economic indicator is unemployment rates and jobs. Obviously, the huge spike in unemployment, short-lived spike in unemployment that we experienced when the pandemic hit in the first quarter, second quarter of 2020. Pretty quick rebound again, continued decline in unemployment rates each month, each quarter since then, back down well below 5% unemployment rate, which historically would be viewed as a pretty low unemployment rate, probably what economists might even refer to as full employment. Historically, above where we were just leading into the pandemic, but still at back to a relatively historic level. The caveat to that is we haven't seen any nominal increase in the number of employees or the number of jobs. So if we look at total number of non-farm employees in the U.S. Going back to 1970, we can see that we're at about 153 million prior to COVID. We had the big drop. We've regained a lot of those jobs. Today, again, we saw an increase in jobs below expectations, but a continued increase in the number of jobs. But we're still not even back to that level of employment that we saw prior to COVID. So, putting those two pieces of information together, lower unemployment rate, but still fewer jobs than we saw previously. That means that we've got a decline in labor force participation rates that, at least in terms of the data that I've looked at, is it's not focused on any one ethnic group, or it's not all just females or males. It's pretty across the board in terms of the demographic groups that they look at those that they measure those statistics for. Inflation is the other big broad economic issue that's in the news and on everybody's minds. So it's true that recent inflation has increased, definitely relative to where we were heading into the pandemic. So the most recent inflation numbers, 6.2% on the CPI, 4.6% on the CPI less food and energy, what they refer to as core inflation. So we have seen a big jump in prices relative to where they were a year ago. That's what these inflation rates represent. And the big question is, are these price increases transitory? Are they temporary, or are they permanent? So are these associated with bottleneck issues, supply chain issues that we keep hearing about that are going to be relatively short-lived, depending on how you want to define short-lived, or are these things that are going to persist moderate term, longer term into the future? The other thing to point out is, even though we've got, strong trends in the labor market in terms of people returning to the workforce, lower unemployment, given the inflation rates we're seeing, despite what would be considered, again, by historical standards, strong nominal wage growth in recent months, the price increases we're seeing are outpacing those wage increases. So increase in nominal wages, but probably negative real wage growth when you include the effect of higher prices. Interest rates are another thing we wanted to just kind of highlight here in the general section. So again, comparing those to some of the inflation measure of 6%. This is just looking at a specific interest rate, the 10-year constant maturity Treasury note. Nominal interest rates are still very low. A lot of speculation about what Fed policy will look like in the coming months, coming quarters, whether those interest rates will start to creep up. But given where we're at right now, low nominal interest rates, relatively high inflation, we're also in a negative real interest rate environment as well, which is one measure that there is the inflation protected security rate for the 10-year treasuries being at about negative 1% currently. The other thing to think about for inflation, one thing we can look at is looking at what market expectations are, at least at some future time horizon. So again, currently we're at an inflation rate of just over 6%, but the market expectations over what would be a 10-year time window is what we're looking at here in the series in red, the 10-year break-even rate. The inflation expectations currently in the market are for inflation to be at about 2.5 over that 10-year period on average. Obviously, that implies the market is expecting inflation to come down from that 6% level over some time frame over the next 10 years and to average 2.5% over that time frame. Exactly how quickly and when that will happen is the $1 million question, so to speak. So, but market expectations are for a reduction in inflation from current levels. And a 2.5% inflation rate would be higher than what we've experienced on average, at least over the last decade. But certainly not out of historical ranges in terms of inflation rates that we've seen. So again, back to this transitory versus non-transitory inflation question. One issue that I think we want to highlight today and emphasize is the labor aspect to that. So, one of the anecdotal examples that specifically is impacting agriculture, or is at least contributing to what's going on in agriculture, is the strike of union workers at John Deere. They did recently come to a new agreement on a contract, and that contract does include an increase in wages, as well as a cost of living increase provision included in that contract. So this is just, again, one example of some of the labor issues that we hear evidence of companies dealing with across the country. Labor in general is short. There's fewer people out there in the workforce than there were prior to the pandemic. There's plenty of examples of businesses across multiple industries talking about labor shortages, difficulties in retaining and hiring new employees. And the outlook, at least from our perspective on that, is that's probably not something that's going to change or adjust quickly. And so we'll continue to be operating in a tight labor market, for the coming years, I would expect. So to summarize the general economic intro here, we do see growth occurring. We do see recovery occurring since the shock of the pandemic in the first half of last year. Labor force however, has not returned to pre-COVID levels and likely will not in the short term. There are some supply chain bottlenecks that are occurring. I think the likelihood of those being relatively short term is probably higher than the labor issue. We'll kind of address some of those issues as we continue on this morning. Again, inflation has increased, at least in the short term. There is this big question about whether it is temporary or permanent. I suppose if your timeline is long enough, everything is temporary. But the question is are we talking months or years in terms of whether we're going to see that inflation rate come down to some of those longer term expectations? And then finally, I think inflation will probably have an impact on at least real interest rates. Even if the Fed does make any significant movements on nominal rates in the coming quarters, we're probably operating in a negative real interest rate environment for the short to medium term. So with that, I think we're going to move on to kind of some more specific ag background to lead into some of the issues that Gary is going to address here at the end of the presentation. But before we get to that, I'm going to have Todd run another poll question.
Indeed. And just a reminder that if you do have questions for Nick or Gary, you can always put them in the question box that's over on the left-hand side of the page, or possibly down on the bottom of the page, depending on what size screen you're looking at. And we will see those questions. Let's go through the poll at the moment. Is your firm looking for employees? Answer this question if you are looking for employees. Yes, desperately. Yes, but not too desperately. We're fully staffed or self-employed, and I don't have workers. So go ahead and fill that poll out. Once we get to about 70% of you, we'll make sure that you see the poll. There are around 200 of you on with us at the moment. Many times folks like to hear what that number looks like. We're not quite at 70%. We're working our way through the process. Go ahead and answer that poll again. Is your firm looking for employees? And here are the answers that we show, with about 61% of you answering that question. Yes, desperately understaffed, according to 7% of those who answered. 46% say, yeah, they're kind of desperate about it. And then the total of 48% say, no, they're fully staffed or they're self-employed. So those are the numbers we see as it's related to employees on the staffing side for those of you who are on board with us at the moment. Now, let's move on with our program. Fine.
No, that's
well,
fine,
actually, Nick, before we get to that, since you're still with us, did you get a chance to take a look at a couple of quick questions for labor that you might want to answer?
Yeah, there's a couple questions here. Labor issues. So for labor-intensive ag sectors, do we predict big increase in robots or increased wages for human employees? I guess would be the implication there, or both. I mean, I think in general, what COVID has done is it's really just accelerated trends towards things that were already occurring. So I'll give my classic vague answer that doesn't really answer this question, but I think trends we are already seeing away from labor use in labor-intensive industries just is going to be sped up by what was experienced during COVID. I probably don't know enough about specifically thinking of like meat packing, what the potential is there to remove human labor from that and go to robotic systems. I don't know enough about the potential there, the technology innovations that could be occurring in that area to say too much about that. Gary, I don't know if you have any comments there.
No, I would agree with you. It's increased that movement, and there was always going to be a labor issue moving forward because of just the demographics of this country, and this made it probably worse it did make it worse because the older generation looked at COVID and saw it and said, I'm done. A significant portion.
I think I can actually add to something to that question and conversation, is that on the warehousing side, there is a shift that's beginning to happen where labor is being replaced. It already has for some time, but this has been accelerated through the COVID process, where warehouses are replacing labor with robots for all kinds of goods that, unlike not grain in particular, but warehouse goods that can be palletized. So I think in that process, certainly the answer is yes. That some of those, even in the ag sector, probably will see some warehousing that is using robots in the future. There's another question there too. Did you want to answer that, Nick?
Yeah, sure. So I mean, it's kind of a very short term for 2022. Do you think consumer price increases, so inflation will, I guess, continue to wipe out some of the wage increases that we've seen? I can never give a definite yes or no answer, but I mean, my expectation on that would be that 2022 is still pretty short term. I mean, we're almost there. If I had to guess, I would say that inflation would remain at or above wage increase levels into 2022. But definitely beyond that, I'd be a little bit less confident in that, in saying that. But Gary, I don't know what your opinion is.
I would agree with that. And I also think it's important that UAW and Deere agreed to a cost of living increase in their contract, because that sort of embeds inflation into the system. And that is sort of what was part of the issue in the late 70s and early 80s with inflation. And then once you have that in that expectation of inflation, you have that built into the system.
All right, so let's move on and do a little bit of ag background. Some of this will be review of material if you were tuned in for especially the farm income outlooks session earlier in the series, I think Monday this week. But again, just to kind of set the stage and set up a few things that Gary is going to address more directly on the input side. So farm income in 2021 is going to be strong. It was strong in 2020. We had, rally in prices at the end of 2020. We've continued to have strong prices in 2021, and we're looking at least for farms enrolled in Illinois FBFM, what looks like probably a record farm income year for 2021. Comparing or kind of linking that to what farmers are doing with some of that extra income, probably one of the categories we see the most action in when we see big income gains or losses relative to previous years is in capital purchase activity. So when farm incomes are high, farmers tend to maintain and improve their capital stock at above average rates and increase those capital purchases. When we see farm incomes fall, we see the opposite. So it's an area where farms can make adjustments. You can always maybe go an extra year without replacing that tractor, or when you've got extra cash, you can replace that capital stock and also obviously use that as kind of a tax management strategy. So projecting what would be also record capital purchases probably for 2021 and seeing record capital purchases in 2020 on farms in FBFM. The other side to look at on the ag background is price levels. So again, we've seen a major rebound in prices relative to where we were at kind of in the 5-year period leading up to the pandemic. The initial scare of low commodity prices in 2020, followed by the quick rebound throughout the fall, and then high and generally rising commodity prices since then. Latest projection from USDA and the November WASDE report. So these numbers that you see on the chart there, 1210 for soybeans, 545 for corn. That is the most recent November projection for corn and soybean national marketing year average prices from the USDA. Next WASDE report, I think, will come out next week, next Thursday on the 9th, I think, is the release date. But that 1210 and 545 level is what USDA is projecting for this 2021 crop that we just harvested. Average prices from now through August of next year. Obviously, we had much lower price levels from the late 70s throughout the early 2000s, and then the run up in prices from the ethanol boom and expansion of export markets for soybeans in the late 2000s. The lower price levels, and then now kind of the increase. And in general, this is a message that's been coming from the folks at FarmDoc for a number of years now. Expectations that we are at a new price plateau relative to where we were prior to 2005. But as we've already seen in the last 15 years, there will be multiple multi-year periods of prices above whatever that new long-term average is, and we might be there right now at 545 and 1210. As well as periods below those longer term averages. Looking ahead to 2022, if we look at fall cash delivery bids in Illinois and what the harvest CME contracts are trading at, fairly similar to slightly lower price levels for both corn and soybeans based on those kind of market indicators for where we're looking at for 2022. So again, historically, what look like pretty positive prices, pretty strong prices, but as Gary will get into, facing some headwinds on the cost side, definitely in the short term, and those things tend to persist over time. And so probably some careful decisions, tough decisions that may need to be made in terms of pricing the 2022 crop, given some of the opportunities that might exist right now. On the acreage side, again, kind of touching on something that Gary will get into as we move on here. Some speculation about what relative prices now suggest for maybe some maybe large movement in acreage shifts for corn and soybeans. So just a little historical context on some of the biggest acreage shifts we've seen historically, at least in recent years, since 1995. So the biggest shift in corn acres we've seen year to year is a $15 million acre increase from 06 to 07. And then that was immediately followed by what has been the largest decline in corn acres year to year, a reduction of 7 million acres from 07 to 08. Soybeans kind of acreage shifts in a similar range, a 10 million acre increase from 2007 to 2008, and a 13 million acre decline from 2017 to 2018. All right, and here's kind of a zoom in on that. Just looking at that 1995 to current day period for those planted acreage on corn, soybeans, and wheat. Added here at least the farmdoc projections. So these were discussed a week ago Monday in the webinar that was done by Joe Jansen and Scott Irwin, the Commodity Outlook webinar. But at least they're projecting a increase in corn acreage from 2021 to 2022, a decline in soybean acres, and those projections are based on much lower, significantly lower corn and soybean prices than what we're currently seeing for fall bids. So again, maybe, an indicator. I tend to trust Scott and Joe in terms of what they think on what cash prices could be next year. So again, maybe an indicator that there's some opportunities to price ahead based on where we see some of those fall delivery bids right now. So, summarize the ag side of things. We are looking at historically high prices. They obviously could go higher with the change in acres or any kind of negative weather shocks that might be experienced here or in other major production parts of the world, and places like South America, whose crop is in the ground now. And probably the other, but there's I think the expectation is we'll more than likely see those prices come down for maybe some of the pricing opportunities that we see right now. And then the other side of things, again, kind of leading to what Gary's going to talk about is the main response that we've seen on farms from higher incomes is in that capital purchase area, less so in other expense areas like family living, which tend to be pretty stable. But capital purchases is where have historically seen the most activity when incomes change, and what the data suggests farmers have done in 2020 and will likely be doing in 2021 as well. So with that, I'm going to turn it over to Gary, and he's going to talk about some specifics on costs.
Yeah, we're going to talk about specific inputs and talk about some of the items that we're seeing here, and we're going to focus on pesticide equipment and fertilizer there at the end. But starting there with number one, we see labor shortages, and this was I put this on there, everyone, which our poll suggested that I should never use everyone like my wife says, but a lot of people are looking for employees, and I don't think that situation is going to change anytime soon, and a lot of people would agree with that. Even before COVID, we were looking at a situation in which the number of younger individuals that were coming into the workforce was going to be less than those that are leaving. It's sort of that baby boomer cohort going away and a much smaller number coming on force, and that was going to be a situation that would persist and was made worse by COVID, in that COVID probably hurried up some of the retirements in the older generation, and then for some reason we can't find some of the workers that used to be there even among the younger people. Seed is probably the bright spot in this whole thing, in that we're only thinking about an 8 to 10% increase in price, and probably not looking at any shortages along the way, but 8 to 10% increase in price, which is going to be the lower end of what we're looking at as far as price increases for the coming year. And again, we're looking at much higher costs for corn. The non-line costs for producing corn are likely to be up $140, $150 per acre from these earlier levels. Then there are pesticide equipment and fertilizer. So let's just go through each one of those, and we'll start out here with a poll here. How concerned are you about glyphosate availability in 2022? So you could answer that. Let's see what you're all thinking here. And we're getting some pretty fast reactions to this poll, and we'll show you the results here in a bit. So if you would continue to vote, that would be good. Again, as we're looking at pesticides, what we are more or less seeing is some concern with glyphosate and glyphosate, and probably then that transforming to or going over into all the other ones. Here are the poll results. 26% of you are very concerned, 59% are somewhat concerned, and 15% are not concerned. So there we go. So we have some concerns out there. Here's what we would say about pesticides. There definitely are supply issues with glyphosate and glyphosate, and they will likely continue. Those issues have resulted from their COVID-related shutdowns in China, container issues from moving the base product from China here to the United States, and then Hurricane Ida closing the Bear plant, which has been recently reopened. All of that would suggest we're going to expect large increases in price of both of those chemicals, and those already happened. And you would also expect to see a large increase in all pesticides, because as glyphosate and glyphosate go up, you would also be expecting their substitutes and complements to go up as well. So that shortage of glyphosate and glyphosate will lead to demand increases for other chemicals. So you're looking for expect large increases in price, and there's probably nothing that you can do about that. I would put my 2 cents in here, in that by the time we come to spring, we will most likely have the supply. Given the price increases, there's a very, very large incentive for companies to be able to provide the product to the final consumer. So that supply will likely be there, but you likely need to reevaluate the pesticide programs in light of those large increases, and whatever that means. But it probably means a lower reliance on chemicals if you can do so. We put this up here as somewhat of a joke. Here you could go back to row calculator, and the joke about this is if you even wanted that piece of equipment, you probably don't have it, and you couldn't get it if you wanted it. And if you because of other items, many farmers may have an old 4, 6, 8 row cultivator in the barn or shed or wherever. You can bring that out and have fun trying to go over the acres.
Teach the tractor operators how to turn around endros again.
Yeah. So
there was an art to that when I was junior high and high school.
Yeah. So we're going to have to
lightning strikes during that time frame when I was in high school.
Yeah. So I don't know. Would GPS? I don't know. We're getting
help. Yes, GPS
would help. But anyway, this is realistically not a large scale option. And again, we're going to have to work with the chemicals that we do have and make the best we can do. We got another poll question here as we launch into equipment. So if you would take a couple minutes and answer this, not in a couple minutes. This is sort of all right. So if you're looking at this, are you above 2020 levels last year? And then did you have availability problems and not availability problems, and then the other ways? You didn't make any capital purchases. Just to get a feel for what's going on out there, we thought this would be interesting. Did you have any problems getting the equipment that you did? And we've seen and heard a lot of issues with equipment and pretty much any sort of utility of physical grain bin, electrical work, everything is in short supply. And frankly, I would not expect that situation to end anytime soon. So we're going to close the poll. Here's what you said, and Jim's going to bring it up here for us. So 56% were above 2020 levels. So 56% were above, and most of you, a larger proportion had availability issues than did not. And then we see the other 33% did not make any equipment purchases. 7 and 3% then did not had purchased less. Let me get up here for some reason. Oh, there it is. I'm sorry. So here's a couple of points that we would make. We know that index or equipment prices have increased rather dramatically, particularly in the last half of this year. This happens to be a USDA index of prices paid for tractors. You can see that has that hockey stick motion there, and it has gone up in recent years or in the last 6 months. One of the things that I would note about this is that when we look at sales, we have actually seen tractor sales up by 11% in the first 10 months of 2021, and combine sales were up by 24%. So setting this up, last year was a record level of capital purchases on Illinois grain farms, and had we not had supply issues, we would expect 2021 to be even higher than last year. So there is a large demand for equipment and other capital items on grain farms. That resulted in part because of large incomes and because of the desire to have a tax shield for that income. So 2021 there was a large demand for capital purchases. That goes along with the supply issues that happened last year, so that we saw that increase go up there, and both of those factors played into that.
Yeah, and I mean, we also have to remember we were coming off a 5-year period where equipment manufacturers had probably made adjustments to much lower demand, then hit by COVID, then hit by a rapid price rally and a quickly changing income outlook in 2020. So, asking a lot of adjustment in a short time period, facing some pretty tough conditions for companies that make products you can't change on a day-to-day basis to make those adjustments so it's not surprising we're seeing, what hopefully are relatively short-term issues.
Yep. And again, though, moving forward, you're never, and I should never use the word never, but those prices are not going to come down in 2022 or 2023. As you can see, there's sometimes when those prices trend down, but not very often. We will see a strong demand for machinery as long as we are projecting good income. We have a comment here, and we do know this. There are issues with parts also. That whole supply chain is problematic, and we all know that you might want to get whatever you can going into spring and fall.
Well, and this is anecdotal, but I do know for a fact that with the strike at Deere, they were actually putting business side employees into kind of more assembly line manufacturing facility roles just to try to keep up with parts needs this fall. So I know Deere commits to parts availability when you buy equipment through them. It's one of the reasons they can get a premium price for their equipment, and they had to scramble this year to do that. And I know on our home farm we experienced delays on parts issues relative to what would be considered a normal year.
And again, we would expect those to be ironed out over time. But again, we have a good demand, and those things those supply issues will get ironed out. But underlying that all is this shortage of labor, which will likely be a more longer run thing. So, if we're thinking we had 6% inflation now, probably not. This is my bias. Probably not looking for that in the future, but labor, we're gonna have to be thinking and paying more for labor as we move on into the future. All right, so we have pesticide and tractor and equipment and parts issues. And then there's nitrogen fertilizer. And this is obviously the big one that has come to the forefront here recently. All fertilizer prices have gone up, but nitrogen have gone up more. Or I don't know, more, but oops, I'm sorry. I got it. So here last month, anhydrous ammonia prices in Illinois were $1,343. I believe, I don't know how far, that's a record level for nitrogen. Last time we were close to this was back in September and October in 2008, and that was the financial crisis. So all fertilizers have gone up. DAP has gone up. Potash have gone up. DAP and potash, you can see here, are also here close to record levels. But probably the most striking one is anhydrous ammonia and the whole nitrogen fertilizer complex. And probably that's the one that will be the most concerning moving into spring. I would note with DAP and potash that those prices are high. One of the things that you might want to consider when looking at DAP and potash is that, particularly if we have soil test levels that are above recommended or near recommended, might want to back off those DAP and potash rates, particularly if you don't believe that a fresh set of fertilizer has any impact on yields. We can probably make that up later in the years. So we've got a question here. So what percent of 2022, so this is for next year, what percent of 2022 need to be applied yet? So if you're less than 10%, you're probably in a position where you put most of your anhydrous ammonia on in the fall, and maybe a little bit yet to go. 100% is you got it all to go, and then we'll see the range here of where we're at here. So just gives us a feel for what decisions left yet need to be made. And again, anhydrous ammonia in the nitrogen fertilizer is probably the one that thinking the most about, because DAP and potash, if you apply those, it doesn't really have much of an impact on the corn versus soybean decision. But if you're putting on nitrogen, you're committing yourself to corn. So here's where we're at. A third have all of it yet to go, or a third have 50 to 100%, and a third have less than 50%. And less than 10% is 14%. And if you had that booked at $700 and $800, you look like per ton of anhydrous, you look like a genius this year. So we're just going to take you through first a calculation of cost, and I'm going to use 2021 cost and 2022 cost. We're doing this for Central Illinois. 234 and 207 are the requirements. 234 is for 2021. 207 is for 2022. And these are based on MRTN. And at these prices last year and this year, MRTN and most decision models will say to lower anhydrous ammonia rates. DAP, potash on both of these are at replacement. So last year, 432 anhydrous ammonia, 428 DAP, 327 potash. We had $94 of fertilizer cost, and that's those three ingredients. I would note that anhydrous ammonia is usually the least expensive form of nitrogen. So if we're putting on 28% or 32% or any of the nitrogen solutions, we're going higher. Here is soybeans, $46. So that was last year's cost, which would have been this year's production. So we did that same calculation with 1,400, 850, 887, and 232 is now the cost this year. So you're seeing there that we're up over $100 per acre, $140 per acre. Soybeans up 46 to 106. So our increases were $138 for fertilizer, $60 for soybean fertilizer. So there's what we're looking at as far as terms of increases. Again, significantly larger increases in both corn and soybean costs. I want to take you through a budget, and I'm going to put this budget in here for 220 bushels corn, 68 bushels soybeans, and using close to the prices now that we have. $5 corn, $12 soybeans. Actually, if you're looking at bids right now, it's above $5 for corn, a little bit less than $12 for soybeans. Put in here $262 for fertilizer, which is up over $100 from last year, and soybean fertilizer costs are up as well. So we're putting in all of those costs, coming up with non-land cost, coming up with an operator and land return, which is return above revenue less non-can cost, and we see virtually no difference in corn versus soybean return. This has some bearing because some individuals some farmers are thinking about switching from corn to soybeans, which does have some merit, but right now prices still point, probably in central Illinois and much of the state, for corn to have more of a return than soybeans. So a couple points here. We have above average prices, fall bids built in here. And one of the things that I would suggest doing from now on is looking at those costs pretty closely as we're moving through time, because those changes, any changes in costs likely are going to be reflected in fertilizer costs, will likely be reflected in prices of both corn and soybeans. We have fertilizer prices are at record levels, and right now, again, it's touch and go whether corn versus soybeans. One of the things, again, that you may be considering doing, if we're going to switch to more soybeans, which again has some merit, if you do it, price the crop, or at least part of that crop, because all these models are suggesting lower prices. So one of the worst things we could do is make that decision and then end up with those lower prices. I'm going to take you through, this is the same graph for anhydrous ammonia that we've looked at, and I'm going to relate that anhydrous ammonia price to two items. The first item is natural gas, and this is natural gas price at Henry Hub, and these are where those prices are near just slightly over $5, a bit down. This would include the November price. I would note here we had higher prices for natural gas and lower anhydrous ammonia prices back here. So we've had a couple periods where those anhydrous ammonia prices, higher natural gas prices, but lower anhydrous ammonia prices. And then there's the corn price. We have a little model where we relate anhydrous ammonia price to corn prices, and we do this with three items: lagged ammonia price, corn price, and natural gas price. And the corn price is the national corn price, and the natural gas price is the Henry Hub price. This model will explain well ammonia prices up to last month, November 2021, and corn price has a larger role in ammonia price, and it's more important than natural gas if you're looking at what causes corn anhydrous prices to move. It's more influenced by corn price than natural gas price. And in November 2021, our actual price is overpredicted. And let me just show you that. So this predicted model comes in close to the actual, and then this is last month. And all of a sudden, we're over $400. Our actual price is $400 over our predicted. And let's just go in and zoom in on that. So it's actually $435 in November. Last year, or excuse me, last month. So the takeaway from that is up until this point, anhydrous ammonia prices were well in line with what we would expect fundamental factors to be. And then November, things went out of whack. So there's this sort of $400 premium built into the market, at least compared to those model results. So one of the key question is what will happen to that in spring? And more specifically, will that $400 premium go away? There are large incentives for that product to be provided, because at those prices, that there is profitability for the manufacturer of fertilizers, and that premium will cause that profitability to exist. There are some other considerations going on as right now. One other item note is that there are very high production costs in other countries. So if we're looking at natural gas prices in the U.S. and comparing that to some places outside of the U.S., natural gas went up much more in other places of the world. So your nitrogen fertilizer prices are much higher elsewhere than here in the United States. And there are countervailing duties in place on a couple of UAN products, which will not help with supply in the U.S. Here are some just general suggestions at this point. At this point, why lock in any or all of 2022 purchases? And this assumes that you don't have the purchases made already. What is the hurry? And at the very least, don't buy all the 2022 purchases at this point. We would also suggest here lower nitrogen application rates. And we have a question here. Are we at the point where yield or production estimates have been influenced by chemical and fertilizer availability? And one of the and that depends a lot on what farmers will do up from this point forward. If we do lower rates, and it depends on where we're at on those lowering rates, if we're above what university levels recommend, lowering the rate to that university level would not result in lowering much yield, and it would actually increase profit. But we aren't to the point where we would say that unavailabilities will be impacting yields for next year. Prices, and we would also suggest pricing more of 22 corn and soybeans, particularly if you're making decisions. So let's go through some strategies here. First, strategy one is obvious. Apply all of book nitrogen this fall if possible. If we can get that on, do so. Strategy two, we don't have fall ammonia booked, but you can still apply and get it. You may want to consider applying, but at a much lower rate. So, and here, this strategy is sort of saying, we're going to put nitrogen on in the fall. We don't necessarily know if that price is going to go down in the spring. Availability may be an issue. This is sort of a fail-safe sort of strategy. and in particular, split applications, and applying 75% of the MRTN, maximum return to nitrogen rate, in fall, and apply the remaining spring after planting, or if we're seeing that later in the year. Here, the strategy, and again, this is a risk management strategy, saying if we have that availability to do some in the fall or in the spring before planting, and particularly in the spring before planting, if prices haven't come down appreciably, let's go for a lower rate and then see what things do in the spring. A fourth strategy here is to apply most of the nitrogen, if possible, as anhydrous ammonia. And we've always known, or it's always the case that anhydrous ammonia, almost always the case that anhydrous ammonia has a lower cost per pound of actual N than 28% or 32% or the other. But those differences may widen this spring, and checking those sources will be pretty critical. Finally, strategy 5 is to reduce rates. These show for different anhydrous ammonia prices on the vertical axis, the suggested rate of N given, and these were generated with the corn nitrogen rate calculator given a $5 corn price. You can see here that as that price increases, the suggestion across all the state is to lower applications. Again, that's looking at a return to that nitrogen and coming up with the most economical rate for making those nitrogen applications, and those are coming down. Look, we're going to put out a little FarmDoc Daily next week that shows what those reduced nitrogens would mean for yields. But again, reducing nitrogens would likely be an alternative. Here to summarize, right now, corn and soybean prices are relatively high. And just so we know, they could go higher. All our models right now are saying that corn and soybean prices are going to be lower in spring and summer, and that would include USDA projections made by Irwin and Jansen earlier on a FarmDoc Daily webinar. All those are assuming that we're looking at normal crops, no big supply or planting changes, and Brazil is going to have a near normal crop. If we don't have any one of those, corn and soybeans can go relatively higher. We would also suggest planting more corn, or probably about the same proportion as last year, and to lower application split rates and take a more wait and see attitude. So, Todd.
Indeed, I'd like to thank Gary, those folks that have helped to support the FarmDoc site. They include the TIA Center for Farmland Research, which you can find at farmland.illinois.edu. That's right here on campus. Compeer Financial, Corteva AgriScience, Farm Credit Illinois, FS Growmark, the Illinois Soybean Association, and the Illinois Corn Growers Association. MRTN, by the way, rates can be found. Then they include all the data. We're pretty proud here at the University of Illinois that the majority of the data, or more than any other state, because the state is only used for the state of Illinois, those in-rate trials are much more robust for Illinois than any of the other states because of the number of data points that are put in. The MRTN can be found at Inrate Calculator. You can just search that Inrate Calculator. It is an Iowa State University website when you get to it, but you can find it for most of the states in the Corn Belt using their data. We would like to also remind you that our educational partners for the day include Illinois Extension and the Department of Agricultural, Consumer and Consumer Economics. We have two more summits that are coming up yet in next week. They include on Monday, Farmland Values with Bruce Sherrick, and on Friday of next week, Nick Paulson will be back along with Krista Swanson and Jonathan Koppas. They'll take you through some policy issues. You can always find the FarmDoc Daily website videos, including IFAS, the Illinois Farm Economics Summits, online at farmdocdaily.illinois.edu. The archive of this summit will be in the webinar section under IFAS. You can find it there, or if you want to just sign up for the YouTube list, you can go to youtube.com/farmdocvideo. That's youtube.com/farmdocvideo. On behalf of Gary Schnicke and Nick Paulson and Jim Baltz, who's been behind the scenes, thank you for joining us today. I'm University of Illinois Extension's Todd Gleason.